Dear friends of making money, today we'll discuss whether staking is more profitable than dividends. But first, what is staking? Well, in simple terms, staking is the process of investors locking up their assets for a certain period of time. This is done to support and validate transactions on the blockchain. Typically, this is done in staking pools, but it can also be done with wallets directly. A staking pool is basically a network of people that combine their staking power to earn more rewards. And this is what the investors are paid in. They paid in additional cryptocurrencies, but they have the chance to earn even more if they help, for example, to add new blocks to the blockchain. On the other side, dividends are already pretty much well known, but they are basically a percentage of the corporate earnings that the company has made, typically profits, and those are distributed among investors. Basically, the dividend percentage is basically calculated with the current share price, and it's a certain percentage that is given back to the shareholders. Of course, depending on the time held and also on the company. As some companies, they pay the dividends out quarterly, but also it's possible to pay them out annually. Now, but why do the percentages differ? For example, for crypto, why are there different rewards regarding the percentage? Well, this can have a couple of reasons. The first one is annual provision. Annual provision basically means that you look at the number of blocks increased on the blockchain compared to the previous year. And this is basically calculated by the inflation rate, as the inflation rate calculates how much it basically compares the previous year to the current year's block supply. On the other side, there's also another factor that is very important. And this factor is the community tax and the bonded tokens ratio. The community tax is basically a small fee that is deducted from the staking rewards. On the other side, the bonded tokens ratio is calculated by bonded tokens ratio divided by total supply. And this basically shows how much rewards are actually distributed among active stakers. Next is the actual staking APR. The actual staking APR may differ from the nominal APR due to factors such as block minting speed and validators' commission fees. And this brings me to my last and also very important factor, is the validator's commission. The validators charge a fee, basically a commission, for providing their services. But the good thing is investors, they can see and they can basically choose who they want to acquire the services. So they have control over how much of the percentage actually goes away. So this helps to optimize earnings. On the other side, dividends can also be impacted quite largely. For example, a very big impact that is, of course, pretty known is the financial health of a company. As companies who are not in good financial health are very unlikely to pay out high dividends, as high dividends can have a strong hit on the financials, as they paid out in profits. And those profits are basically booked as a liability as they go away from the company to investors. And this brings me to my next point. It can also be the case in terms of expansion, that the company wants to expand and they don't have a lot of resources. They don't have a lot of resources to give back to the investors, so they will keep most of the money and they will reinvest it in the company to experience further growth. And this typically means that there are not high dividends, or sometimes there are even no dividends at all. What is also very important is the competition, as the companies regarding in different sectors, they have different perspectives and there are different measurements basically. And they look at the competitors, how much they can pay out, and they want to stay competitive, of course, as it's still a race for them. And of course, they like to pay back investors, but also this means a lot of costs. Now, there are some important things that we need to consider before deciding what is better. Actually, there are some pretty interesting facts that I found. First, that when comparing the top 100 cryptocurrencies, the Bitcoin and the other altcoins, the top 100, their actual staking APR is on average about 6%, which is a lot higher than the S&P 500, which is at about 1.1%. However, this does not mean that it's necessarily better. And what is also interesting regarding the stock market is that those companies who were in the highest quintile of dividends usually were outperformed by the second quintile, which is pretty interesting. And this basically can be explained as those companies, they have a strong hit on the financials, as the companies who have a really high dividend, say even 10%, 11%, it's a very strong hit on the financials. And this can also prevent basically further growth and expansion. However, what is also generally noticeable is that those companies who paid dividends generally performed better than those companies who didn't, as those companies who were paying out dividends, they are pretty sure that they're pretty confident in their future, as they are able to pay out dividends. So on average, they're doing pretty well. Also, what is important to notice in the crypto market is that while you can have high percentages, this can also change due, for example, to the transaction volume, or for example, the volatility of the coin, or the active participants of staking. It can be the case, for example, that the percentages are adapted in a negative way. And what is also very important is that when you pick, for example, an altcoin other than Bitcoin, most of the altcoins are mainly controlled by the top 50 to 100 holders. They hold usually over 70%, which is quite a lot. So they have a lot of influence. They can basically, in bad times, if they sell all their coins, they can sell all their coins, and this will lead to a major price crash, which is of course terrible, also for the staking. However, this is not the case for the stock market. As on the stock market, there is a lot more regulation. You cannot just easily acquire like 5-10% without anyone knowing, and you're not anonymous. So this is in this regard pretty good, as with the percentages being so widely distributed, it makes it less volatile for price crashes, which is pretty good. And even if there were like people who try to do that, they have to face the SEC and their regulations. And the SEC, if the company, or in this case a crypto coin, would need an individual or company, if they want to acquire 5%, 10%, the SEC will check if it's possible. They will not just immediately, you cannot just buy it like in crypto. So the volatility in this regard is a lot better. So what do we pick? Are dividends better than staking? In my opinion, I think dividends are actually better. Well, there might be some arguments for both sides, but I think dividends are better first, because for me, basically, dividends are something that you will invest more money in. And with dividends, it's a lot more safe. The SEC, the regulations, I feel a lot more safer when I do the dividends. And I personally, I'm not a big fan, because for me, investing in crypto is reasonable, but I would not go in crypto for staking, as the volatility is already so high that you can make a lot more with the investing rather than the staking. As the staking, while of course there is no lockup period anymore, but still, if you do the staking, the price volatility has a big impact, as even if the actual staking APR may stay the same over time, you're paid in additional cryptocurrencies. And this means that if the price of the cryptocurrency massively goes down, the staking rewards are not pretty valuable. This is a big problem. Also, I think other than investing in dividends, it's something that you can do for a long term. And there are actually pretty good deals. In my opinion, it's pretty unreasonable that you can make like 20-30% on staking. As well, the dividends, they may offer only like up to 10%. They're pretty good deals, and this is basically safe. As well, of course, the prices can change. The regulations are a lot more clear, and it's a lot more secure. And also, when you're looking at the history and the crypto prices, they have gone up and down, and there's, in my opinion, it's not changing anytime soon. As while there are more regulations, it still will need to take some time, and you're not as much dependent on a handful of people. But of course, investing, I think, can be a good idea in crypto. Of course, this is not a financial advice. Cryptos are pretty risky, and in my opinion, they are at the moment they're calculated gambling. As while the regulations are not that good, the transparency is not that great, but I think you can make a lot of money. And like, especially for people who don't invest a lot, it will take forever in the stock market to make a substantial amount of money. So I think regarding investing, it can be pretty interesting. Also, when looking at the moment when there's, for example, the Bitcoin that is currently, as I'm recording this video, there's an ETF launched in China. And also BlackRock is filing for an Ethereum ETF, which of course will be pretty interesting to see regarding the price movements. But of course, I can be completely wrong. You can have your own different preferences, but I think, for me at least, staking is a lot more risky. And there's no lockup period at the moment, but in my opinion, you make the percentages with the trading, and you don't make it with staking, in my opinion. But of course, everyone can have a different opinion. I'm curious to know actually, what do you think? Do you think that staking is actually pretty much boring and doesn't get enough reward over the years? Or do you think that, or you agree with me that, and you say basically that staking is actually pretty useful and you can make a good percentages if you do it right? Let me know. I will see you in the next video.